The world's energy lifeline is under pressure. The Strait of Hormuz, a narrow stretch of water off the coast of Iran, has become the focal point of a global standoff. Nearly a fifth of the world's oil passes through this choke point. Now, amid intensifying conflict involving Iran, the strait is blocked. The result? Disrupted trade, volatile oil prices, and a surge of diplomatic maneuvering as major powers scramble to restore the flow. For governments, businesses, and consumers alike, the stakes could hardly be higher. With tankers stuck, oil shipments delayed, and prices fluctuating, the global economy is feeling the consequences. Iran's new traffic system for the waterway has only deepened uncertainty, introducing layers of bureaucracy and unpredictability to a region where time is money. As China calls for an immediate reopening and the United States urges Beijing to use its leverage, the world is watching. The Strait of Hormuz isn't just a regional dispute, it's a test of the global system's ability to respond to shocks and restore efficiency when it matters most. Why does a single waterway hold so much sway? Geography and economics have made the Strait of Hormuz indispensable. This 21-mile-wide passage links the oil-rich Gulf states with the rest of the world. For decades, it has served as the main artery for the export of crude oil, liquefied natural gas, and other commodities. The world's largest economies depend on its uninterrupted operation to keep industry moving and markets stable. When the strait is blocked, energy supplies are threatened, shipping costs rise, and financial markets react almost instantly. Historically, the Strait of Hormuz has always been a flashpoint. From the Iran-Iraq War in the 1980s to more recent tensions between Iran and the West, the threat of closure has been a recurring source of anxiety for global markets. Every time tensions have flared, insurance premiums on tankers have spiked. Traders have rushed to secure alternative supplies. Governments have launched emergency plans to ensure energy security. But never has the strait's closure lasted long enough to fundamentally alter global trade flows, until now. This time, Iran's conflict with its regional adversaries has escalated to the point where the strait is not just threatened, but actively blocked. Shipping lanes are closed, vessels are rerouted or stranded, and the cost of moving oil has soared. In response, Iran has rolled out a new traffic system, claiming it will bring order to the chaos. In practice, it has added layers of red tape and uncertainty. Shippers are forced to navigate a maze of permits, inspections, and arbitrary rules. The result is inefficiency, anathema to global markets that prize speed and predictability above all else. The economic consequences are immediate and far-reaching. Oil prices, already sensitive to whispers of conflict, have swung wildly. At first, the market braced for a sustained supply shock, but reports of possible agreements between the U.S. and Iran have led to falling prices and buoyant stock markets, as traders bet on a swift resolution. The prospect of reopening the strait has injected optimism, but Iranian officials remain skeptical. For now, the uncertainty persists, and so do the risks. Diplomacy is working overtime. China, as the world's largest oil importer, has called for the immediate reopening of the strait in high-level talks with Iranian officials. For Beijing, the calculus is simple. Stable energy supplies are fundamental to economic growth and social stability. Any disruption threatens China's manufacturing sector, export performance, and ultimately, its place in the global economic hierarchy. The United States, meanwhile, sees an opportunity. By urging China to use its influence over Iran, Washington hopes to leverage Beijing's economic incentives to restore the free flow of trade. Both powers recognize that market efficiency demands political solutions. In the midst of this, Syria has adopted a position of neutrality. While the region is polarized, Damascus is positioning itself as a potential mediator. This isn't just diplomatic posturing, it's a calculated move. By staying neutral, Syria preserves its own economic interests and increases its diplomatic capital. If Syria can broker a deal, it stands to gain international legitimacy and access to economic rewards from both sides. Yet the path to resolution is far from clear. Iranian officials remain wary of proposed agreements, questioning the sincerity and feasibility of Western offers. You're watching Today in Context, where we go beyond the headlines to explain the forces shaping the world around us. If this kind of analysis helps you make sense of the bigger picture, like the video and subscribe for more. The history of failed negotiations and broken promises looms large. For Iran, control over the strait is not just a bargaining chip, it's a source of leverage in a broader strategic contest. Relinquishing that leverage requires guarantees that are hard to secure in an environment of mutual suspicion. The vulnerability of global supply chains is once again on display. Oil tankers, container ships, and insurers are recalibrating their risk models. Companies are exploring alternative routes, but none are as direct or cost-effective as the Strait of Hormuz. Every extra mile adds to shipping costs, insurance premiums, and ultimately consumer prices. The market's quest for efficiency is being tested by geopolitical realities. For energy markets, the stakes are existential. The world's reliance on oil flowing through the strait is a reminder of the fragility of global trade. Disruptions don't just affect oil exporters and importers, they ripple through every sector that depends on affordable energy. Manufacturers, airlines, and logistics firms all feel the pinch. Market efficiency can be restored, but only if the strait reopens and confidence returns. The diplomatic chess game underway is driven by hard economic incentives. China's appeal to Iran is underpinned by its need for energy security, while the U.S. seeks to protect its allies and stabilize global prices. Both powers understand that prolonged disruption undermines economic growth, investor confidence, and political stability at home. The pressure is on to broker a deal, not out of altruism, but because the costs of inaction are simply too high. As negotiations unfold, the possibility of partial or temporary agreements looms. These deals may allow limited shipments or reduced restrictions, providing some relief to markets. But unless a durable solution is found, the underlying risks will remain. Iranian skepticism suggests that any agreement will be hard-fought, with each side seeking maximum advantage. Looking forward, several scenarios are possible. The most optimistic sees a swift diplomatic breakthrough, the reopening of the strait, and a return to market normalcy. Oil prices would stabilize, trade flows would resume, and the global economy would breathe a collective sigh of relief. In this scenario, the crisis becomes a case study in the resilience and adaptability of global markets. A more likely outcome is a drawn-out process of negotiation and incremental progress. Shipping may resume in fits and starts, with periodic disruptions and continued market volatility. Prices could remain unpredictable, and companies would adjust their strategies accordingly, diversifying supply chains, hedging risk, and investing in alternative routes. The efficiency lost may never be fully recouped, but the system would adapt as it has in the past. The most concerning scenario, of course, is a prolonged blockade. If diplomatic efforts falter and the strait remains closed, the consequences could be severe. Global oil supplies would tighten, prices would spike, and economic growth could stall. The ripple effects would be felt from Shanghai to London to New York. Governments would be forced to intervene, releasing strategic reserves, subsidizing critical industries, and perhaps even rationing energy. Market efficiency would be sacrificed on the altar of geopolitical rivalry. Whatever the outcome, the crisis at the Strait of Hormuz is a stark reminder of how interconnected today's world truly is. Economic incentives, geopolitical rivalries, and the quest for efficiency are inextricably linked. The actions of a few states can send shockwaves through the global system, affecting billions of people. The challenge for policymakers is to recognize these linkages and respond with realism, pragmatism, and a relentless focus on restoring stability. The lessons are clear. Trade flows are the lifeblood of the modern economy, and their disruption carries costs that extend far beyond the region. Diplomatic pressure, market incentives, and the pursuit of efficiency will ultimately shape the outcome. Whether the Strait of Hormuz reopens quickly or remains a point of contention, the world will be watching, not just for signs of peace, but for proof that the global system can still deliver in the face of adversity. In the end, the fate of the Strait of Hormuz will be determined not just by military might or diplomatic bravado, but by the underlying economic interests at play. As governments negotiate and markets react, the balance between efficiency and security will shape the decisions of states and the fortunes of millions. For now, the world waits, hoping that pragmatism and economic realism will prevail over conflict and uncertainty. The crisis may not be over, but it has already offered a powerful lesson in the fragility and resilience of global trade. As the ships wait and the world holds its breath, one thing is certain: the efficiency of global markets will always be a powerful force, pushing states towards solutions that benefit not just themselves, but the entire interconnected world. The stories that define tomorrow are already unfolding today. Subscribe to Today in Context for clear, grounded analysis of the events shaping our world, one story at a time.